Welcome to this beginner's guide to investing from a beginner. Now, this is not a video where I advise you on how to manage your money or what to invest in. I'm a beginner myself, so I'm still learning about this area too. The point of this video is to share what I've learned about investing so far, with the hope that it will give you some ideas of some of the things you could investigate further to build your knowledge and to make the best investment decisions for you. So let's jump in. Firstly, let's start with the basics. What is investing? At its core, investing is simple. Instead of letting your money sit idle in a savings account, you use your money to buy something that might increase in value or provide a return. Why should I invest? Well, simply put, it's a way of growing your wealth. The easiest way I think about this is, imagine you have a cake. Instead of eating it all at once, you give a slice to someone who promises to return it with a little bit extra cake. Over time, that little bit extra accumulates, and you end up with more cake than you started with. This principle of growing your wealth is at the heart of investing. What is an appreciating asset? Now, this term may sound complicated, but it's not. An appreciating asset is something you own that increases in value over time. Real estate, like your house, stocks in growing companies, or even collectibles can be examples of appreciating assets. The opposite of an appreciating asset is a depreciating asset. For example, a car, which loses value as it gets older. Now we come to the important concept of risk and return. You've probably heard the saying, higher risk, higher reward, and this is very true for investing. In general terms, the higher the risk of the investment, the higher the potential reward. The lower the risk of the investment, the lower the reward. The key is to strike a balance between your financial goals and your risk tolerance. We'll come back to this later when we talk about diversification and index funds. Now we get onto the awesome topic of compound interest. Warren Buffett, probably the most famous and perhaps the most successful investor of all time, said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." And Albert Einstein even said that compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. So with that in mind, what is compound interest? Well, remember that cake example from earlier? Compound interest is like getting extra slices over time and having those extra slices earn even more slices. It's the interest you earn not just on your original investment, sometimes called the principal, but also the interest you earn on the interest previously accumulated. Here's an example. Imagine you have $1,000 and you invest it in something that gives 5% compound interest. 5% of $1,000 is $50, right? After 20 years, you would not have an extra 20 times $50, $1,000 for a total of $2,000. Instead, you would have over $2,600. This is because the first year you would have made your $50, 5% of 1,000, but the next year you would have made $52.50 because you're earning 5% on $1,050. Fast forward to year 20, you would actually earn $126.34 in interest that year, not $50. This is why compound interest is so powerful. Over a longer period, compound interest can result in exponential growth in your investment. What is even more powerful than compound interest is when you have compound interest and regular investments over a long period of time. Let's take another example. Let's say you start with a $2,000 investment, and then you find a way to put aside and invest an extra $2,000 each month into the same investment that returns 10% each year. If you stick to this for 20 years, your total investment would be worth over $1.5 million. But what's crazy is that you would have invested $482,000 over those 20 years, but you would have earned over $1 million just in interest. The earlier you start investing, the more time your money has to compound, which can lead to significantly larger gains. Let's take this example and increase it to 30 years. Your investment would be worth over $4.5 million. But what's even more amazing, you would have invested $722,000, but made over $3.8 million in interest. Can you see how compound interest is so powerful? Every time I do these calculations, it just blows my mind, like what I wouldn't give to be 20 years old again, right? If you were 20 and you invest like this, you'd be a millionaire by 37 and by age 50, you'd have almost $5 million. And that's not taking into account any other investments you may have made. Crazy. If you want to do some calculations like this by yourself, smartasset.com has a simple calculator you can use. There'll be a link in the description below. Now, this is all well and good, but you have to find an investment opportunity to take advantage of compound interest. An area that caught my eye, and something I'm going to talk about now, is the area of index funds. Remember earlier when we talked about risk? Well, a common way to reduce risk is to diversify your investments. This is just a fancy way of saying don't put all of your eggs into one basket. If you invest in Apple and Apple's share price goes down, you will lose money. However, if you spread your investment between Apple and, say, 9 other companies, if Apple's share price drops, you will not take such a big hit. And that's because you've spread your investment, you've spread the risk. Although diversification doesn't eliminate risk, it can reduce it. A great example of diversification is to invest in index funds. Now, it's a little bit more complicated than this, but basically, you invest in a fund that spreads your investment over multiple companies with the aim to replicate the performance of a specific market. They are therefore seen as lower risk compared to other types of investments. Speaking of market indices, the S&P 500 is one of the most referenced ones in the world. It is a stock index representing 500 of the largest companies on the stock exchange in the US. When people say the market is up today, they're normally referring to the S&P 500. By investing in an S&P 500 index fund, you're essentially betting on the growth of the US stock market. Remember that compound interest example from earlier, where you can have a multi-million-dollar investment by investing $2,000 a month? Well, the S&P 500 grows on average 8 to 10% each year. So if you want to follow the example from earlier, the S&P 500 index fund may be something worth investigating. Next, I want to share some things which have popped up time and time again during my research. Things to keep in mind, things to look out for, potential pitfalls when investing. But before that, if you've liked this video so far, I'd really appreciate it if you could like the video, subscribe to the channel. It makes such a difference. So what should you keep in mind when investing? Firstly, stay informed. The investment realm is always evolving. It's important to keep a pulse on global trends and understand how they may impact your investments. Manage risk. While it may be tempting to chase the latest high-flying stock or cryptocurrency, always assess the risk associated. Ensure your investment aligns with your financial goals and your risk tolerance. Regularly review and rebalance. The right asset allocation today might not be suitable 2 years from now. Regularly review your portfolio and adjust as necessary to align with your goals. And what are some of the potential pitfalls you should look out for? Following the herd. Just because everyone else is investing in the next big thing doesn't mean it's right for you. Avoid making investment decisions based solely on hype and fear of missing out. Overconfidence. It's natural to feel confident after a few successful investments. However, overconfidence can lead to poor decisions. Always base your choices on research and analysis rather than emotions. And finally, neglecting fees. Over time, fees associated with managing and trading can eat into your returns. Let's take an example. Let's consider the scenario of 2 investors, Alice and Bob, who both decide to invest in similar funds that offer, on average, a 7% annual return before fees. However, the funds they have chosen have different fee structures. Alice chooses Fund A, which charges a relatively lower annual management fee of 0.5%. Bob opts for Fund B, with a slightly higher annual management fee of 1.5%. Let's see the impact of these fees over a long 30-year investment, assuming both start with an initial investment of $10,000 and make no additional contributions. Over the 30-year span, Alice's investment has grown to over $114,000, while Bob's investment has reached $86,000. The difference in their ending balances is around $28,000, solely because of that 1% difference in fees. I hope you can see the long-term impact of seemingly small fees. While 1% may appear tiny on the surface, compounded over time, it can consume a significant portion of potential earnings. This is why neglecting to account for fees when selecting investments can be a costly mistake. So there we have it. A Beginner's Guide to Investing from a Beginner. As I said earlier, the point of this video was to share some of the things that I've learned about investing so far, with the hope that it will give you some ideas of things to investigate further, so you can build your own knowledge and make your own decisions. I really hope you found this video useful. Good luck with your research, good luck with your investments. It's been a pleasure. I'll see you in the next video.